today for our webinar, Rapid Monte Carlo Simulation for Forecasting, Stress Testing, and Scenario Analysis. Our presentation today will last about 45 minutes, and we'll be assembling questions which you can submit through the GoToMeeting toolbar. At the end of the presentation, we'll try to answer as many questions as we can in the allotted hour. My name is Larry Roadcap, and I lead FI Consulting's commercial practice. For those of you who aren't familiar with FI Consulting, we are a boutique risk analytics, financial modeling, and technology firm based in Arlington, Virginia, right on the Potomac across from Washington, D.C. And we serve the government sector as well as the private sector with a particular strength in credit reform as well as credit risk for real estate, small business lending, and consumer finance. In putting together the materials for today, we wanted to highlight some emerging technology trends such as in-memory processing, parallel processing, and open source code. In particular, we've shown some examples in Apache Spark. We find that a lot of these are being applied by financial risk managers to improve efficiency, improve speed, and reduce cost. And we thought that this would be an interesting set of technologies to speak to for something as computationally intense as Monte Carlo, with which you might be familiar. Leading the presentation today is Rob Chang of FI Consulting. Rob is a senior analyst with the firm and works quite a bit on model development and model validation for our clients. He was previously a financial engineer and exotic options trader for several hedge funds and banks in London, Singapore, and Hong Kong. He received his master's in mathematical finance from Columbia University and his bachelor's in political science from Berkeley. Our guest speaker today is Dr. Joe Pimbley, founder and principal of Maxwell Consulting. Joe is well known as a member of the Risk Professionals Editorial Board from GARP and is a member of the Executive Advisory Board of the Quantitative Finance and Risk Analytics Master's Program at the Lally School of Management at Rensselaer Polytechnic Institute. Joe is an expert in complex financial instruments, financial risk management, structured products, and quantitative algorithms. And his earlier Wall Street roles, he acted as a quantitative analyst, risk manager, derivatives trader, and portfolio manager, reaching the level of executive vice president and head of institutional risk. His experience includes leadership of business groups, information technology, enterprise risk management, and quantitative modeling teams. Joe is also author of Banking on Failure, Simple Money, and Advanced CMS Process Technology. He has written more than 30 finance articles, presented more than 60 finance seminars, and holds numerous patents for engineering inventions. Joe received his PhD in theoretical physics from Rensselaer Polytechnic Institute. And before I hand it over to Joe, I wanted to first take a poll of the audience and ask, when did you last use Monte Carlo simulation? And you'll see a poll appear in your GoToMeeting toolbox. And the options are this month, this year, more than a year ago, only for school or training, or never. And we'll close the poll in just about 20 seconds. Okay, we're closing the poll. It looks like about 21% have used it this month. Interestingly, almost 40% have only used it for school or training purposes. So as you can see, Monte Carlo is something that is used, but I think today we have an audience of folks that are interested in seeing its practical applications. With that, I'd like to hand the presentation over to you, Joe.
Well, Larry, thank you very much for handing that over. and the introduction that you gave. But let me first thank all the participants here. I appreciate very much your time in joining us. And while the webinar format is in some sense convenient for all of us because we're all at our own locations, the disadvantage is that we're not in the same room. So let me second what I think Larry said, which is we welcome questions. We'll take questions at the end. But Rob and I and my colleagues at FI would both be very happy to receive communications from you later. We'll give our contact information for questions by email later or anything of that sort. We'd very much welcome interaction. We love this topic, and again, we're happy you're joining us. Second, let me thank FI Consulting. I've known friends at FI for a good time now. Enjoy very much working with them, especially on this project of speaking to you. What's the word? I'm very happy and impressed by the work that Rob Chang is going to show a little bit later. So I hope this is a great experience. And as we said, please feel free to reach out to us. So Monte Carlo simulation. The most important thing is that it's everywhere. In other words, in the financial world, excuse me here. Okay, I'm sorry. Good, okay. In the financial world, much of what we do is Monte Carlo. It's just extremely valuable as a tool. But also even outside of the financial world. In fact, earlier, engineering and science problems that we need to solve, Monte Carlo is great for those as well. And we won't go into that. Let's just make the point that it's a great software tool for addressing problems. And two important takeaways that we'd like you to get from this presentation, clearly more than that, but the two big headlines are, number one, that Monte Carlo always needs to be faster. Okay, obviously we make it as fast as we can, but you can always do better if your Monte Carlo simulation is faster. That's not true of all software, right? Clearly you want software to go faster, but if you're loading a web page, for example, at some point it doesn't matter, right? Once you're fast enough, that's okay. With Monte Carlo, though, you can always get more benefit by being faster. For example, more precision in results. When you're running Monte Carlo trials, if you're fast enough at one setting, you can increase the number of trials and get more precision. But one of my favorite reason is what I call run more experiments. And what I mean by that is one of the two best uses of models is simply what it teaches you. And you're sitting in front of your computer of some kind, you've just created a model to value a certain kind of new exotic option or to test the risk of your trading floor, and you care a lot about small questions. How does the maturity of this transaction affect the price? Right? How does my volatility treatment affect the amount of risk that I have here? And really the model often, not always, there are different kinds of models, but this kind of model is meant to teach you. It's not meant to get answers that you then give to somebody else. And when you're sitting in front of a computer, even if it takes just 3 or 4 minutes to run a calculation, you're less likely to use that to teach yourself as opposed to it taking 10 seconds instead of 3 or 4 minutes. So the model is more useful the faster it runs. That's always the case. Now there are other examples, right? What I call real-time risk management is a very hard goal to achieve because risk management by its nature applies to portfolios of risk. Really, it's not just, let's look at just one security. I mean, that's in underwriting, in making investment decisions, in hedging decisions, looking at one security matters, but much of risk management involves large portfolios. So in the industry, you've achieved a good result if you can just run overnight calculations that look like at an end-of-day portfolio. And even getting a large portfolio to run meaningfully overnight is a good task. But clearly, if you could make that even faster to make it much more of a real time that used during the day, then that would be more valuable. That's just, again, another way of saying that when you reach a plateau of Monte Carlo calculation in a certain context, it can always be faster, and that would always give you an improvement. That was lesson or advice, we'll call it number one. Unlike most software, other software, Monte Carlo always needs to be faster. The second is that it's almost always possible to get it to be faster. Okay? And by a combination, either one thing alone or a combination of things. One is just hardware. If you have high performance processors that you can switch to that's better than what you're using now, for example, using a cloud service where somebody else owns the equipment and they're experts in maintaining it and keeping it updated, then you can use that service, you can do better. Or you can write your software in parallel for parallel processing. Rob Chang will address both of those issues as well as a few others in his portion. I'm going to talk a little bit about the software, which is just the code, and saying optimized code is kind of a fancy way of saying what I really want to say, which is, look, just look at the code, and we'll give some real examples. Look at the code carefully where it matters most and see what you can make better and faster. Okay? And before moving off this second point, which again, only 2 points. One is Monte Carlo always wants to be faster. Number two, you can almost always get whatever you have now to be faster. This is a disadvantage of off-the-shelf software products here. Now, I'm a believer in third-party assistance. Quite often because you can hire people to come in who do whatever they do for a living, whether it's writing the software itself. They may not be experts in the things that you're expert in for the risk or the quant calculations, but they can help you with what they're truly expert at. But in Monte Carlo, a lot of the optimization focuses on the specific problem you're dealing with. So again, you take advantage of specific aspects of the problem, and we'll mention that in a minute as well. So again, it makes it harder for a third-party product to be what you need right away. So let's give a few examples. And then after the examples, we'll focus on one and look at ideas for improving code. It's almost like if we start at the beginning of quantitative finance. A lot of people, I'm kind of both. Don't focus only on the underlying theory of quantitative finance, but that's a good place to start if nowhere else. If we look at some of these stochastic differential equations that say underlie, valuation techniques or the risk management where we have stochastic processes for underlying variables like equities and interest rates and commodities and currencies, one way to start is with stochastic differential equations. And I've put essentially the three, call them the, not easiest, but kind of the most basic processes here, stochastic processes, a normal process, log normal, and at the top a mean reversion idea. And each of these we can solve analytically on their own. That's why I kind of like them, that you can actually, you don't need to do a numerical simulation, Monte Carlo simulation. If you had just one variable, like say an equity price, and you wanted just to assume it was log normal, you could write down a solution for the future density function of values. But when you get to any interesting, realistic problem, whether it's just in one variable, but certainly if it's more than one market variable, like interest rates plus equities, then almost certainly you need a numerical method of some kind. And Monte Carlo is like perfectly suited for this, just especially the way I wrote this slide. That you see we have this random variable epsilon. It's natural that inside your code that becomes in this case, the normally distributed random number that you let the computer generate, and you plug that into whatever you want the algorithm to tell you about, whether it's risk or valuation, for example. But again, so this is a kind of a broad example of just about anything you can write a differential equation for, you can use Monte Carlo, and that's a lot. Okay. Let's give a somewhat more specific example of what I call simulation for collateral defaults. And what I have in mind here is structured products. RMBS, CMBS, CDOs, CLOs, which I've been working on more recently. These are where an SPV for a structured product is a lot like a balance sheet of a company, right? You have assets on the left-hand side, and in fact, that's what I call collateral here. And in fact, the collateral in these kinds of transactions or securitizations is almost always debt-like collateral, not commodities, not equities. And so therefore, the stochastic process of interest, at least in this example, is defaults, whether the bank loan, of the 200 bank loans you have in your CLO, how many of those default within a given time period, all that kind of thing. So the left-hand side are the assets, the right-hand side are the liabilities, which in this case are all the tranches or classes that investors have purchased, from the senior tranche at AAA all the way down to the equity. Okay? So you can write a Monte Carlo calculation to simulate performance, and what you ultimately care about, whether you're a rating agency or a possible investor, or you're the banker trying to sell the deal to other investors, then you like the idea of creating a model that looks at what is the risk and return of each particular investment on the liability side. So Monte Carlo is great for this, okay, because the basic driver of this is the uncertainty of the assets, or in this case, the bank loans and their defaults. So what would you do in this Monte Carlo simulation? It's, number one, you set the initial conditions. So you know your assets at time zero, you know your liabilities, what the investors have purchased, you know all the relevant terms, reinvestment period, maturity of deal, most importantly, what's called the waterfall, which is essentially the income statement of this effective deal. So you set the initial conditions, and if it's a 10-year transaction, I mean, CLOs are a little bit longer than that for legal final, but you take a step forward. Imagine taking a step forward in time with your software. You change the yield curve and any other market variables that matter. You investigate, or you determine how many, in this case, bank loans have defaulted in that particular period of time. It might be, say, simulate every quarter. Record all the scheduled asset payments, make the scheduled liability payments. See, this is what software is great at. You can just program in what is supposed to happen at each of these time steps. And actually, at this point, it's good to point out that this is a great example of how a Monte Carlo software doesn't necessarily, well, let me say it this way, that you can amend the Monte Carlo to be more efficient by using a different idea. So we can, collateral defaults are a unique kind of simulated entity that you can simulate all of them first in kind of one calculation, as opposed to doing this explicit time stepping. Time stepping still matters for other kinds of variables like yield curve, but you can do the collateral defaults much faster. So it's a great example of where you wouldn't just call a third party and say, do exactly what I'm writing down here, because once you've done that and you think about it, it turns out to be faster to handle the collateral defaults a little different way. So let's keep going here. And really, that second step was where almost all the work gets done. The third step is, okay, you've done your time stepping all the way through your 10 years. That's, call it one Monte Carlo trial. That's one possible sequence of events for those 10 years. At that point, you record the loss to any investors. For example, it might be that the three most senior tranches suffered 0 losses, but the bottom debt tranche and the equity suffered large losses. Okay, that might be the result of that one possible sequence over 10 years. So you record that in your software, and then you go back and do it all again. And you might have 10,000 Monte Carlo trials or 100,000 Monte Carlo trials, which means you just do that same thing 10,000 or 100,000 times. And at the end, once you've done this for your specified number of trials, you estimate what I call the density functions for losses to each tranche, which is a fancy way of saying You just, essentially add up all the scenarios that cause losses, and that's your probability of losses essentially for that. That was an example. Here's what looks like it's a pretty much different example. I'll call it simulating bank asset defaults. And really, this picture that I show here is taken from a banking simulator. So imagine what we just talked about, that we have a CLO where we want to simulate its performance to maturity. Now put the CLO to the side and think about a bank. How similar is a bank to a CLO? Well, in some ways, it's similar. You have assets. It's the defaults on the assets, which is the main driver of the performance of the bank. You have liabilities of a bank. You have equity of a bank, for example. But what makes a bank much harder is that there's much more freedom for the person running the bank, say the CEO, to make decisions every quarter. You can buy and sell new assets every quarter. You can issue debt or issue equity or sell or buy back equity or raise dividends or lower dividends. You can do those kinds of things every quarter. So in that sense, that whole concept of managing the transaction is much more important for a bank. And in fact, what I love most about banks, and let's get out of Monte Carlo for a minute here, what I love most about banks is that they're very hard to understand. Whenever I've been in a credit committee or an investment committee involving whether my firm should take risk to certain bank debt, what you learn in those committees is nobody really, the banks are hard. You ask them, well, gee, on that, in their prop trading desk, what risks are they taking and what's the likelihood of taking a large loss there? Well, your analyst can't answer that. It's a hard question. And in fact, some of the best experts in bank analysis that I've known have essentially told me, nobody really understands banks. And so that's actually why we created this simulator, just for the interest of it, of let people use the simulator and see what works best in terms of debt maturity profiles, amount of leverage, dealing with regulator stress tests that come every year. So in fact, this particular simulator is you can look at it at the website I give at the bottom, this bankmaxwell.azurewebsites.net, and we use Monte Carlo inside that to evaluate both the defaults of the assets, some very low risk, some very high risk, but also the credit spread movements of the assets, which are important for the mark-to-market of the balance sheet, which of course affects the leverage, not to mention the net income and all of that. So it's actually yet another use of Monte Carlo. And what's most important here is not the specific stochastic process we use, but rather what's most important is the fact that you have to capture that stochastic aspect, that variability, that it's not deterministic. We can't say that if you buy these particular assets, the bank stock price will go up. And obviously that's not how the real world works. So let's get to our last example here before we dig in and dive deeper, and that is the Vasicek default model. Now, if you're not familiar with this, we give a reference a little bit later, which I'll point out that you can look for. And this itself is not Monte Carlo. What the Vasicek default model is an analytical solution for a very simple problem, but it's simple in a way that includes something we care about. It says, let's look at we care about loan portfolios. That's what a CLO is, as well as a bank for the most part. We care about loan portfolios, and we want to know the distribution or the probability of, say, any amount of losses in that portfolio. And we need to factor in correlation. That's what it really does well. That correlation is very difficult to understand how to put that into our analysis, but we all know it's important. Vasicek does that the simplest possible way and lets us get an analytical solution. So for me, why this matters for Monte Carlo to first order is it's a great test of a Monte Carlo code. If you build a Monte Carlo calculation to understand default distribution of a loan portfolio, and you might make things pretty complicated and realistic, we hope, but you are always able to test your calculation against the special case of VASICheck. When you're testing code, as you know, very important to always be able to test what you do, because the whole concept of building code is you create something, most likely there are mistakes, you find the obvious mistakes, and you have to keep working to find all possible mistakes. Comparing to something like VASICheck is a great idea. So of those 4 examples, we're going to dig in a little bit on the last one. Even though it's not explicitly Monte Carlo, as we did say, it's great for testing Monte Carlo. And before I talk about this specific problem, let me point out that at the bottom is this formula. That's essentially the end result of VASICheck. And what it represents is a cumulative distribution function for loan defaults. Say that's what small x is. You make it losses or defaults, but let's call it defaults. Is an analytical function of both the probability of default of each loan, which is this small p over here, which factors into k, which appears in here, and also the correlation row. Okay? So again, it's a nice, if you're a math person, you love this kind of thing, but it's actually nice and concise in one place here. So just, well, within the past few years, I worked on a project with a colleague of mine with auto loans. We were studying auto loan ABS. The firm I was working with as a consultant at the time had a great deal of data on auto loans, many different pools. Let's say they had as many as 20 pools, each pool having thousands of auto loans. And my colleague suggested, hey, let's just see what happens if we assume that a VASICheck framework makes sense, that each of these loans is roughly, the fact that we put them into one cohort, they're roughly the same default probability. Let's just, for simplification, say there's just one correlation or a blended correlation that matters. Can we look at these 20 data points that we have from historical defaults in 20 pools and infer what the probability of default and correlation might be? And that we did that with a maximum likelihood estimator. And just to test that, we built the Monte Carlo, which was great because the Monte Carlo is a test of that analysis for auto loans. It's also a test of the VASICheck model itself. If we or somebody else made a mistake in this derivation, and of course it's also a test of the Monte Carlo. That you must have 3 different points that you're testing at the same time. And so we built Monte Carlo simulation, which we'll show and which Rob will work with as well, where we have some number of pools n. Within each pool, we put capital M loans, and we just run Monte Carlo to determine number of defaults within each separate pool, and then plot those final pool default fractions and compare that to a VASICheck distribution. And I'm going to skip quickly over this and note that because those comments are in a different web page that we've put together. If it's interesting to you, look at this web page, this webjo.azurewebsites.net, and go look here. And what we did here was we wrote this Monte Carlo simulation in one of the .NET languages with Visual Studio for this web application. And you can see that you can, on this web page, you can do this yourself. Enter a number of pools, I guess we said 2,000 here. Number of loans, call them obligors per pool, 10,000. And just calculate the Monte Carlo result, which is in blue here. And we compare that to the exact VASICheck formula we showed on the prior slide, just to see if these things correspond or not. And of course, in this case, that works out very well. I'm not showing the result of the maximum likelihood evaluation. That was a separate project, and that actually worked out very well. So what we had derived made sense. Also on this web page is a reference that describes in more detail the VASICheck model. So if that's of interest to you itself, you can go to this web page, read the other comments, and see that reference. So let's jump into the code improvement, and we're using this VASICheck-like calculation that we just showed to look at code improvement. we had written the other software in a .NET language. Rob later is going to be writing this in Python to look at something and show you what he added to that. Here I have the algorithm in VBA, Visual Basic for Applications, which is part of Excel. So I have this basic model in Excel first. I built it there first and put it in Visual Studio later. And the main point here is that all Monte Carlo simulations have the common feature that the code where Monte Carlo happens is a small fraction of your code. But that's where all the important stuff happens, because that's where the code spends most of its time. So when you want code to run faster, then you need to look at that one focused part of the code. In this case, it's an inner loop where there's an outer loop that goes number of pools. There's an inner loop that does number of obligors. Given that we chose numbers of 2,000 and 10,000, there are essentially 20 million calculations or runs through the statements in this inner loop here. So the point being, let's look at the very small number of lines of code we have here and see what can be faster or better. So we're going to look carefully at each line of code and, as we say, reduce the expensive calculations. A good first place to start is to notice that inside this loop, we keep calculating the square root of 1 minus rho, obviously rho's correlation. Well, when you think about it, you probably don't need to do that. You can do that assignment or figure out to just compute the square root outside the loop, and you don't need to keep doing it again inside the loop. Another place to look is at this norms dist function. This is the normal cumulative distribution function. As you know, it's an integral that can't be evaluated except by numerical methods. When I say application.normsdist, we're really using just the Excel function in our VBA code. That's a convenient thing to do, but it may not be the best thing. And then third, we're also calling a subroutine. So just looking at this call, we don't know how good or bad that subroutine is, but since it's inside our critical area of code, we need to go look at that subroutine to make sure that's efficient as well. Okay. So here are our results. We're just looking at this. The example I had in mind, or the example I described to you, running in Excel with that VBA code that we're using here, takes 120 seconds with the code as written. So the 2,000 pools, the 10,000 obligors per pool, that takes 2 minutes to run. And again, for me, 2 minutes is not bad, but you're not going to do as much if you have to sit or run as many calculations for your experimental purpose if you need to sit in front of your screen for 2 minutes each time. When we fix this one problem of calculating the square root of 1 minus rho outside of the loop and storing it to a value, and then using that value inside here, we do gain a small amount. We reduce our execution time by 3 seconds. You know, that's not terrible, but it's not that good either. We do find, though, a very big improvement if we just get rid of that norms dist with the Microsoft function and replace it by a different subroutine that I'm not showing right here. So I just called it jnormsdist. But let me tell you what it is. It's just there's an excellent reference called Numerical Recipes for things exactly like this. And I simply, with attribution, it's public domain, wrote a subroutine using that code, very little code to write. But it turns out, it's just by this measure, it's 4 times faster than using the Microsoft norms dist function. Not surprising, maybe. I mean, it kind of surprised me when I did this, but in hindsight, maybe not surprising. But what that also tells you is it confirms our opinion that really what happens inside this inner loop is what matters a lot to the code. Otherwise, making a change here wouldn't have such a big difference, taking execution time all the way down to 28 seconds. But we can do better than that. In fact, a better idea is that we can get rid of that norms dist function altogether, whether it's from Microsoft or whether it's from numerical recipes by doing the following. What we had before was essentially that the Gaussian normal CDF evaluated with a random variable, that's what this OB-RV is down here, is less than a probability of default. So we were evaluating this inequality essentially 20 million times. Well, you can just mathematically, you can rewrite that as random variable less than phi inverse, the inverse normal CDF of the probability of default. Mathematically, those are equivalent. And so if it's an advantage to use the second form than the first form, then you would do that. Now, the point, as you can probably see here, is it's not that the phi inverse function is more efficient. In fact, that evaluating that function takes longer than the normal function. That would call it the forward function. The normal CDF is easier to evaluate numerically than this phi inverse. Okay, but the important point is, since the PD, the probability of default, is not changing inside the loop, we can just evaluate this once outside of the loop, and that's what we do up here. We give this variable a new name, phi inverse default probability, and we evaluate it just once. So it doesn't matter if this calculation is expensive. We're not doing it 20 million times, right? Now, and in fact, I'm even using the Microsoft version of this here, and I'm not worried that the Microsoft version might be slower than a subroutine I can find somewhere else, because I'm doing it outside of the critical part of the code. Now, when we do that, we get that 28 seconds down to almost 8 seconds. So that's another big saving, almost another factor of 4. Finally, as the last step, and I'm going to go quickly through this, I went to the random variable subroutine that I'm using. It's a Box-Muller algorithm. It's decades old, very important, very well known, and looked at that to see how to make that faster, and there was no, it didn't matter. So I'm not going to spend much time. I'll just say that when you go play with that subroutine, what you find is you can make things a little bit faster, but it's not even worth talking about. So, quote unquote, fixing the random value routine had little benefit. So let's recap what happened though. We started out with 120-second execution time. We went and looked at just a few lines of code and played with it, changed something, changed a few things, and we got a speed improvement of 15 times just from making code simpler, or faster, I should say. So at this point, let me say that was the simple code improvement part of this, and I'll hand it off to Rob Chang to talk about his exciting part.
All right. Thank you, Joe. We're a little bit short on time. We're actually going to run another poll question, so we'll skip that for now. And just to answer on the audience questions, we are recording the webinar. It will be made available to all participants, and we're going to have 5 minutes for questions at the end. Okay, so moving on to Apache Spark. Before we get into that, we should talk about serial and parallel processing in general, just for those of you who might not have a lot of background on parallel processing. Basically, most of our programs that we write are actually in serial, meaning that instructions are executed one at a time. Now, the advantage of parallel processing is that you can break up all the calculations you need to do to run concurrently. That will speed up a lot of execution time, and processes, instead of running one after the other, can now be run simultaneously. So what is MapReduce? You might have heard a lot about MapReduce or Hadoop. It's basically a parallel processing framework that is quite popular nowadays. And it basically splits up a parallel processing task into 2 parts. One is a map job and one is a reduce job. And just to give you a little bit of background again, and there are a lot of resources on the web about this if you're interested, a map job, what it does is it takes a set of data and it converts it down into key value pairs. It also usually has a function that is mapped to each element. So basically what we're going to show you later is that we're mapping our default function
to each individual borrower in each individual loan pool. The reducer does exactly what you think it would do. It takes the output from all the individual mappers that are sent out to all these different processors, and it reduces the output. Now, reduce can mean many things. It usually means summing across the cluster. But it might be multiplying output, but in our case, we're simply going to add up all the individual defaults of all the individual borrowers and get one default count. So we're actually going to execute in Spark, and Spark is a framework that sits on top of the Hadoop ecosystem. And Spark is kind of an extension of the typical MapReduce framework. It's open source, and it performs calculations in memory. And it uses what are called resilient distributed data sets, or what are called RDDs. And the key idea behind the RDD is that individual data packets can be recomputed on failure, and they're resilient and fault tolerant, making Spark very stable to do MapReduce functions. So here's the same code that Joe provided, and we're going to show it to you in Python, but it has the exact same functionality, and it's going to produce the exact same output. Here's our function that we're going to map to each individual borrower, and that's the default function. Now, what the function does is simply check to see if the borrower is defaulted or not based on a draw from a random distribution. If the borrower has defaulted, then a 1 gets added to that default count within the function. After that, we perform a parallel process on all the individual borrowers, and we're going to map our default function to each individual borrower. And after we do that, we're going to have a total default count for every borrower within each pool. And then it's simply a matter of dividing by the total number of obligors, and you get the default fraction, the fraction of defaulters within each loan pool. We can even extend the example a bit to include LGD and make it varying. As you saw in the previous example, the loss given default was set at 100%. Now, in actuality, borrowers might have different levels of loss given default, and we might want to vary it to make the example a little bit more realistic. So in our case, we simply devise a simple function that computes the LGD based on the random draw for the default calculation. Now, if you want to implement this type of model yourself, you have a lot of choices on how you want to implement LGD. It doesn't necessarily have to be stochastic. It could even be deterministic. And in our example, we simply compute LGD by taking the CDF of the random variable used to determine PD, and we subtract it by 1 to get the LGD. Okay, now we're going to run our example in the cloud, because running your example in the cloud is how you really harness the computing power of a clustered computing network. And I'm just showing you a screenshot of what I'm running it in, and I'm running it in Amazon Web Services. And you have a lot of choice here. There are a lot of providers of clusters, out there. You can use Microsoft Azure, for example, but I'm using Amazon for the purpose of this example. Or you could have your own local network as well, which might be more secure. But for this demonstration, we're going to use Amazon Web Services. And I'm also running it on Elastic MapReduce. And again, you have a choice there as well. You can run it on EC2 or another Amazon service, but I'm using Amazon's Elastic MapReduce. You can see a couple items of my configuration. I'm using Amazon distribution 2.72 and EMR version 4.6. Now, I have some screenshots of my output, but we're going to try to actually demonstrate this live. So let me get set up here. Okay. Now, I've already, okay. Okay. So here's my Python code, and you see it's the exact same code that we used before. And here is my instance of Spark Shell, and I simply connected to the Amazon Web Cluster on the internet, and then I ran their Spark that was already installed on Amazon Web Services. And what I'm going to do is simply copy the code over. And now Amazon's running. Again, this is a pretty lightweight cluster. You can definitely ramp up the processing power depending on your needs. But for this simple example, I'm using, I think, 4 cores. So we'll let that run. And you see here, we're getting the same output. Unfortunately, it can't be graphical on this Spark shell, but we're just getting the same output of the x-axis being the default fraction, and then the y-axis being the counts. Let me show you a little bit more of my configuration screen. Amazon has these nice monitoring statistics where you can see how your jobs have been performing, what has been running, how much time they took to run, and how they've been submitted. Okay, since we're running a little bit short on time and we want to make sure we leave time for questions, I think we can wrap it up here and start taking some audience questions. So if you have a question, please type it into your chat box and we'll try to address it.
So Rob, I do see one question here that I'd like to read out, and that is, how do you validate whether you are correctly estimating the underlying distribution that you are trying to estimate, especially in the tails? Let me give you my thought on that, and Rob, if you wanted to throw in too. My thought is that's a great question. I mean, in other words, is how do you validate your model? And I would say 2 things, which are 2 different questions. Right. One is first to validate that your model is doing what you're telling it to do. In other words, in our case, that you know, we can only run a finite number of trials, but we compare that to the exact distribution that we know in that VASA-check case. Right. So in this one case that we know we're validated against what we're trying to do, because we were able to identify the special case, the VASA-check distribution, that we could solve analytically. Now, so clearly, in much of what you do in Monte Carlo, probably almost 99% of what you do in Monte Carlo, is there is no exact solution. So it's always possible you could have an error, and you always, when you're writing the code first place, when you're testing it originally, but even as you're using it going forward, you always have to be sensitive to how do I know this is right. And step 1, which I just said, was take a very special case that you do have an analytical solution for, make sure it runs there. Beyond that, it's just using whatever ingenuity you have to test the algorithm. And it may be that you find an error a month or 2 down the road. But the point is, there's no guarantee way to do this other than just finding ways to test yourself, like, hey, I just ran one case. The second deal should be more risky than the first, but my calculation doesn't show that. Why is that? And you dig into that kind of thing. That was question number 1. Question number 2 is, well, how do I know that my model is actually a good estimate of reality? That when I go look at, say, the tail distribution of equity movements over a 1-month period of time, if I model it as a log normal distribution, then how do I know that in reality I'm capturing the fat tails? And the answer is that's a problem, because you don't, right? I mean, being good at modeling means, number 1, obviously you get the model right, that what you're trying to do. But number 2, that you have to be sensitive. This is only an approximation of reality. And the best thing to do, if you really care about those tails, is to get as much historical data as you can and show that, you know what, log normal was great for the, everything in between, 1% and 99%, but it wasn't so great for further out in the tails, and to do your best to estimate how much different those tails should be and build that into your model. And even if it's an ad hoc thing to do, make sure that the people using the model, the people you're giving it to, make sure it's informed by that history.
Okay, we have another question asking about why would it be more secure to put the example on a local server rather than on Amazon? And the issue there is that when dealing with sensitive data, like modeling credit data and things like that, many companies have internal policies about putting that data on public clouds. So Amazon and Azure, while they do have a lot of protocols and things like that, the data is not really residing, within the confines of your firewall. So many companies out there have their own local clusters and networks of computers that they can set up where you can run the same software, internally. However, for companies that don't have the resources to do that, I do think the cloud is a very good option. So you're still able to take advantage of parallel processing. However, there are tiers of security you might be able to purchase on public clouds, and for the federal government, they do have GovCloud options.
Good. Rob, here's a question. It starts off, I am really impressed by the webinar. So first of all, for Rob and myself, thank you very much. We appreciate that. Which textbook or material would you recommend? So Rob, for both your part and my part, I guess there are two separate things. Those are a split question. For my part, you know what? I could say this numerical recipes textbook is great. That's a good place to go, but really, more than a textbook, I think this is the kind of thing you learn by doing. And the way I learned code and the way I keep improving in code is by, if somebody else around me is really good at code, then I'll review their code. I'll say, can I borrow that? Can I work with that? Can I improve on that? But you kind of just looking what other people have produced and building on that yourself, I think is very valuable. And just so the best way to learn is really just to do it. Okay? For optimizing code, for example, Rob, what would you say for how you would learn to use cloud services? How you learn your database work? How did you do that?
I would say that if you wanted to repeat the example that we ran today, or you wanted to run your own examples, the best thing to do is to get a good book on Spark. There are many different ways to implement Hadoop and run MapReduce, and definitely you don't have to use Python. A lot of the programs are written actually in Java or Scala. However, I think Spark is the most user-friendly to actually get up and running and implementing MapReduce jobs quickly. I think Python is a very easy and flexible language to work with, just to kind of get started. And I definitely think that using a PySpark shell, or which a Spark book will teach you how to do, is definitely the best way to get up and running on MapReduce.
Well, in the interest of time, I'll close the questions, but I did want to thank Rob and Joe both for their time today, and thank you for attending today's webinar. We will be sending out a recording of this webinar to everyone who registered, and I believe that you'll see that within a week, if not sooner. In the meantime, if you do have any questions, don't hesitate to reach out to Rob or Joe. Their email addresses are on the screen now, and I'm sure they'd welcome your feedback and questions. Again, thank you very much for joining FI Consulting for today's webinar, and we look forward to seeing everyone again.